The reason why we like looking at one month implied vol is it's quite short dated, so it still moves around a lot, but it's not crazy short dated where it's like 1 week stuff, where implied vol is not really, 1 week options aren't really about implied vol, they're about time decay, right? Because they're decaying so fast. So we're trying to find that sweet spot in 1 month where the implied vol actually matters. And when you trade a one month option, your Vega exposure matters because it's significant and you are exposed to that implied vol going up and down. So that's why we look at 1 month vol, and we look at the IV rank on an 18-month history. So we see where that is in its range. So right now, for example, something that stands out to me is copper with a 0% rank, which means copper is on its 18-month lows in terms of vol. So it's very, very cheap in terms of implied vol for copper. We also look at TS, which is term structure. If that's a positive number, that means it's an upward sloping curve. If it's negative, it's a backwardated or inverted curve. What that kind of tells you, generally, when you're in an inverted state, it means the market's a bit choppy, and right now there's kind of quite a lot of anticipation of short-term movement. If we're in an upward sloping curve like all of these greens here, and particularly nat gas, it's basically saying this asset is not expected to move much in the next week. Right, so when you're in a super steep contango, that's when this number is very positive, and that's the options market way of saying to you, yeah, not a lot's going to go on in this asset. Okay, in the super near term. Now that doesn't mean they're always going to be right, but at the end of the day, that's what the options market expectation is, right? And the reason why you're monitoring these markets constantly is you want to know what the volatility players in this market think about future realized volatility, right? And that's what that's telling you. Then we've got realized vol, which we turn into where we look at 10-day realized vol. Again, that through doing it for many, many years, I find that's quite a nice sweet spot to look at, the 10-day realized, because it captures 2 weeks worth of price action. It's very relevant to what's going on now. It's not so long dated that it catches like moves that happened months ago that was outsized, and it distorts the realized vol number. So that 10-day realized is quite quick to adjust to what is happening now in the market. And I like that. So it's quite a good high frequency number to use. And then we compare that. So we take the average of the 1 week and the 1 month implied vol. And then we compare the realized to that implied vol average. And we take a ratio there to see what the carry is. We call it carry. So we take that carry, which is a difference between the implied vol average and the realized vol. We divide that by the implied vol average, and that gives us the carry percentage. So you can see right now we've got positive carry across most assets. Actually, FX is where there's the most positive carry, but the problem with FX is it's such low vol, you don't really want to sell it. But you look at the sectors here, they're all in green. You look at most of the indices, they're all in green. So what's that telling us? That's telling us that selling optionality is the better way round right now in terms of the way things have been moving. Now, remember, realized vol is backward looking, implied vol is forward looking. So it's not a foolproof statistic, but the idea is if markets continue doing what they have been doing in the last 10 days, you'd rather be short options than long them right now across most assets. That's what the carry is telling us. Okay.